There is a powerful, almost irresistible urge hardwired into the human psyche. It's an itch that demands to be scratched, a silent scream in the back of the mind that says, do something, anything. This is the action bias. It's the force that makes a soccer goalie leap to one side during a penalty kick, even though statistics show they'd save more shots by simply standing still. It's the impulse that drives a CEO to greenlight a dozen mediocre initiatives rather than patiently waiting for one truly transformative opportunity. It's the whisper that convinces an investor to constantly tinker with their portfolio, buying and selling, churning their own account into a fine dust of commissions and bad decisions. Our world worships at the altar of action. Hustle culture, grind culture, the relentless glorification of being busy, these are the gospels of the modern age. We are taught from childhood that effort equals results, that motion equals progress. But what if that's a lie? What if the most powerful, most profitable, and most strategic move you can make, in most situations, is to do absolutely nothing at all? This is the central paradox of Warren Buffett's entire philosophy. He has built an empire valued in the hundreds of billions of dollars, not through a flurry of brilliant actions, but through a lifetime of disciplined, strategic, and often excruciatingly patient inaction. He has become one of the wealthiest men in human history by mastering the art of sitting still. This isn't about laziness. It is the calculated conservation of energy, of capital, of intellectual and emotional bandwidth, reserved for those vanishingly rare moments of near absolute certainty. It's the discipline of a crocodile, lying motionless for days, appearing to be asleep, until the perfect prey wanders to the water's edge. Then, and only then, does it strike with an explosion of decisive, overwhelming force. What we are about to deconstruct is not just an investing strategy, it is a complete mental model for decision-making in any high-stakes environment. It is the principle of selective inaction, the direct antidote to the action bias that sabotages the ambitions of millions. We will dismantle this principle into its core components, revealing how a commitment to doing almost nothing can become your single greatest advantage in the pursuit of wealth, success, and genuine financial freedom. Our journey begins with the foundational idea that governs this entire system, a concept so simple yet so profound it can permanently alter your approach to every major decision you ever make. It is the philosophy of the punch card, the power of extreme selectivity. Imagine for a moment that when you were born you were handed a small paper punch card. This card has only 20 holes in it, and for the rest of your life, every time you make an investment decision, you have to use up one of those 20 punches. Once they're gone, they're gone. You can't make any more investments. How would that change your behavior? You would become incredibly careful. You would wait and watch and think. You would only swing at the ideas you were absolutely certain about, the ones that were so obvious, so compelling, that they were practically guaranteed to succeed. You wouldn't waste a precious punch on a speculative fad or a hot tip from a friend. You would treat every decision with the gravity it deserved, because your lifetime of opportunity is finite. This, in essence, is the mental model Warren Buffett has used his entire life. He operates as though he has a 20-punch card. This single idea is the bedrock of his selective inaction. It forces a degree of discipline and patience that is almost alien in a financial world that thrives on constant activity. It transforms investing from a game of frantic speculation into a disciplined hunt for the rarest of opportunities. The foundational anecdote that best illustrates this punch card mentality didn't happen in a boardroom or on the floor of the stock exchange. It happened in a classroom with a group of business students. Buffett was explaining his philosophy, and he presented them with this very idea. He told them, "I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it so that you had 20 punches, representing all the investments that you got to make in a lifetime. And once you'd punched through the card, you couldn't make any more investments at all. Under those rules, you'd really think carefully about what you did, and you'd be forced to load up on what you'd really thought about. so you'd do much better. This wasn't just a clever teaching tool, it was a window directly into his operational code. And nowhere is this code more evident than in his 1972 acquisition of See's Candies. This wasn't a complex tech company or a sprawling global bank. It was a simple, family-owned chocolate company based in California. At the time, Buffett's partner, Charlie Munger, brought the deal to him. See's was earning about $2 million a year after tax, and the owners wanted $30 million for it. Buffett's initial analysis, based on the book value of the assets, was that the company was only worth about $8 million. His instinct, trained by his mentor Benjamin Graham to buy assets for far less than their tangible worth, was to say no. A price of $30 million for a company with only $8 million in tangible assets seemed absurd. This is where the path of the 99% would have ended. The average analyst, the typical fund manager, would have seen the numbers, declared it overpriced, and moved on to the next 100 ideas, the next flurry of activity. But Buffett was operating with his punch card. This wasn't just another ticker symbol. He was forced to think deeper. He didn't just dismiss it. He and Munger started to investigate why See's was so special. They realized the company possessed something intangible, something that didn't show up on the balance sheet. A powerful brand, customer loyalty that was almost tribal, and pricing power. People in California didn't just buy See's chocolates. They had an emotional connection to them. They would happily pay a premium for that familiar black and white box. Buffett realized he wasn't just buying machinery and inventory. He was buying a piece of his customers' minds. This was a durable competitive advantage, an economic moat. He spent weeks, not hours, thinking about this single decision. He considered the long-term prospects. Would people still be eating chocolate in 10, 20, 50 years? Yes. Would they still be willing to pay a little more for a brand they trusted and loved? Absolutely. He understood that the $2 million in earnings wasn't a static number. Because of the company's pricing power, that number could grow year after year without needing significant new capital investment. The price of $30 million was still a sticking point. He and Munger negotiated, and they eventually got the sellers to agree to $25 million. Even at that price, it was more than 3 times the book value. It was a huge conceptual leap for Buffett, a departure from the strict cigar-butt investing of his early career. But because he was using a precious punch, he had done the deep, exhaustive work. He saw the decades of value that the spreadsheet jockeys, with their frantic search for the next trade, had missed. He made the decision. He punched the card. That single $25 million investment has since generated over $2 billion in cash for Berkshire Hathaway, a return of more than 80-fold, without requiring any significant additional capital. It was a monumental home run, and it was only possible because the punch card mentality forced him to pause, to overcome his initial bias, and to think deeply about a single exceptional opportunity instead of chasing 1,000 mediocre ones. That is the power of extreme selectivity in action. The psychological principle underpinning the punch card mentality is a powerful counterattack against 2 of the most insidious cognitive biases that plague modern decision-makers: the paradox of choice and decision fatigue. In our hyper-connected world, we are drowning in options. There are thousands of stocks to buy, hundreds of business strategies to pursue, dozens of productivity apps to download. The common assumption is that more choice is always better. But psychologists Barry Schwartz and Sheena Iyengar have demonstrated conclusively that this is false. When presented with too many options, the human brain becomes overwhelmed. Instead of making a better, more informed choice, we tend to either make a worse, more impulsive choice, or we freeze completely, a state known as analysis paralysis. The sheer volume of possibilities is mentally exhausting. The punch card is a brutal but effective filter. It artificially creates scarcity in a world of overwhelming abundance. By telling yourself you only have 20 slots, you are immediately liberated from the need to analyze thousands of stocks. Instead, you have to create a set of ruthlessly high standards. You're not looking for a good idea, you're looking for a 1 in 1,000 idea. This framework forces you to ignore the noise and focus only on the clearest signals. This directly combats decision fatigue. Psychologists have shown that our capacity for making rational, high-quality decisions is a finite resource, much like a muscle. Every choice we make, from what to eat for breakfast to which email to answer first, depletes this resource. As the day wears on, our decisions tend to become more impulsive and less disciplined. This is why judges are more likely to grant parole in the morning than in the afternoon, and why you're more likely to buy a candy bar at the checkout after an hour of grocery shopping. The average investor, a prime example of the path of the 99%, subjects themselves to crippling decision fatigue. They check the market constantly, they read dozens of financial news articles, they debate buying this, selling that. By the end of the day, their decision-making muscle is exhausted, leaving them vulnerable to emotional, fear-based mistakes. Buffett's approach, his selective inaction, is a masterful act of cognitive energy conservation. By deciding upfront that 99.9% of opportunities are an automatic no, he saves all of his mental energy for the handful of decisions that truly matter. He is not fatiguing his brain with the day-to-day chatter of the market. He is resting, waiting, preserving that finite resource of high-quality judgment for the moment a seize candies comes along. This isn't just a quaint analogy. It's a sophisticated psychological hack for improving the quality of your most important life decisions. By limiting your options, you short-circuit the paradox of choice and you preserve your mental firepower, ensuring that when you do act, you are acting from a place of clarity and strength, not fatigue and overwhelm. So how do you translate this from a folksy analogy into a practical, applied mental model? You build your own punch card. This is not a hypothetical exercise. It is a tangible blueprint for superior decision-making, whether in personal finance, entrepreneurship, or executive leadership. Step 1 is to define your circle of competence, which we will explore in a later chapter, but for now, understand that you can only punch for things you truly understand. Step 2 is to establish your non-negotiable criteria. Before you even look at an opportunity, you must have a written checklist of what constitutes a punch-worthy investment for you. This is your filter. For Buffett, it includes things like a business he can understand, with favorable long-term economics, run by able and trustworthy management, available at a sensible price. Your list might be different. If you're an entrepreneur, a punch might represent a new product line or a major strategic partnership. Your criteria might be, does it align with our core mission? Does it have a clear path to profitability? Do we have the internal talent to execute it flawlessly? Can we become number 1 or 2 in this market? Write these down. Make them concrete. This document is the guardian of your punch card. Step 3 is the process of active waiting and vetting. You don't hunt for ideas to punch. You let them come to you, and you subject them to your rigorous checklist. For every 10 ideas that cross your desk, 9 should be discarded within the first 5 minutes, because they fail your initial criteria. For the one that remains, the real work begins. This is the deep dive. It means reading the annual reports, studying the competition, talking to customers, understanding the industry inside and out. It means spending weeks or even months on a single idea. The goal is not to find a reason to say yes. The goal is to find a single, definitive reason to say no. You are actively trying to kill the idea. Only the ideas that survive this brutal process of elimination are even considered for a punch. Step 4 is the rule of conviction. When an idea has passed every single one of your tests, you don't just dip your toe in. You act with massive force. You don't buy a tiny position in your 20 best ideas. You make a huge bet on your single best idea. This is the essence of loading up. Buffett doesn't own hundreds of stocks. Berkshire's portfolio is heavily concentrated in a handful of companies he understands with absolute conviction. Each punch on the card should be significant enough to have a material impact on your long-term financial welfare. It forces you to have skin in the game, which in turn forces a higher standard of diligence. This applied blueprint is a radical departure from the modern ethos of diversification and constant activity, but it is the practical path to implementing the discipline that built the Berkshire Hathaway empire. To truly appreciate the wisdom of this path, we must examine its antithesis, the path of the 99%. This is the world of the hyperactive investor, the frenetic entrepreneur, the busy CEO. This individual believes that activity is achievement. Their mantra is, "Don't just stand there, do something." They wake up, check the pre-market futures, and immediately start looking for action. They subscribe to newsletters that promise hot stock picks. They listen to pundits on financial television who breathlessly report on the day's biggest movers. They might be a day trader, executing dozens of trades a day, convinced they can outsmart the market through sheer speed and volume. They celebrate a 2% gain on a trade, ignoring the fact that after commissions and taxes, their net gain is negligible. More importantly, they are playing a game of chance, not a game of skill. They are a gambler, not an investor. Each decision is a shallow, impulsive bet, not a deeply researched conviction. Over time, the friction costs of this constant churning, the brokerage fees, the bid-ask spreads, the short-term capital gains taxes, act like a constant, grinding headwind, ensuring that even if they get lucky a few times, their long-term trajectory is inevitably downward. Or perhaps this person is an entrepreneur infected with what is often called shiny object syndrome. They start a business with a clear vision, but are constantly distracted by new possibilities. One month they are chasing a social media strategy, the next they are pivoting to a new customer segment. The month after they are trying to integrate the latest AI fad into their workflow. They launch new products before their core product is even perfected. Their team is perpetually confused, their resources are spread razor-thin across a dozen half-baked initiatives, and their core business never gains the traction it needs to succeed. They are perpetually busy, their calendar is packed with meetings, but they are mistaking motion for progress. Their company is a treadmill, generating a lot of heat and noise but never actually moving forward. They have used up their entire 20-punch card in the first year on 20 different, underfunded, and poorly executed ideas. The result is not a robust enterprise, but a fragile collection of failures. This is the disastrous consequence of rejecting the punch card mentality. It's a world where the urgency to act tramples the importance of thinking, where the quantity of decisions is valued over the quality of decisions. The path of the 99% is a crowded, noisy, and ultimately impoverished road paved with the wreckage of impulsive choices. The direct financial connection between the punch card mentality and massive wealth creation is stark and mathematically undeniable. It all comes down to two powerful forces: the magic of compounding and the tyranny of friction costs. Let's quantify the impact. Imagine investor A, who follows the path of the 99%. He makes 20 trades a year. He gets some right, some wrong. He aims for small, quick profits. Let's say his average winning trade is a 10% gain, and his average losing trade is a 10% loss. He's right about 55% of the time, which would make him a trading genius. After 20 years, even with this heroic success rate, his portfolio is likely to have underperformed a simple index fund. Why? Because of friction. Every time he buys or sells, he pays a commission. He loses a tiny slice to the bid-ask spread. And every profitable trade he makes is a taxable event, with a significant portion of his gains skimmed off the top each year, preventing that money from compounding. His frantic activity is a massive tax on his own returns. Now consider investor B, who operates with a 20-punch card. Over 20 years, she makes only 10 investments. She waits, patiently, for years at a time, holding cash. But when she acts on a high-conviction idea that she has researched for months. She isn't aiming for a 10% gain. She's aiming for an investment that can double or triple over the next 5 to 10 years. Because she buys and holds, her capital is allowed to do its work uninterrupted. The miracle of compounding, where your earnings themselves start generating earnings, is unleashed in its purest form. A dollar that doubles every 5 years turns into $16 over 20 years. A dollar subjected to the constant friction of taxes and trading fees struggles to even double or triple in the same time frame. Furthermore, her tax bill is massively deferred. She pays taxes only when she finally sells, decades down the line, allowing the government's share of the money to work for her for years. The financial impact is not just a little better, it's an order of magnitude better. The selective investor who makes a handful of great decisions will, over a lifetime, accumulate wealth on a scale that the active trader can only dream of. The punch card isn't just a philosophy, it is a mathematical certainty. It is a direct line to leveraging the awesome power of long-term compounding, the single most powerful force in all of finance, and the true engine behind all great fortunes, including that of Berkshire Hathaway. This discipline of extreme selectivity, however, is only one half of the equation. It tells you to be patient, but it doesn't tell you what to be patient for. A punch card is useless if you don't know where to punch the holes. This brings us to the second fundamental pillar of Buffett's system of inaction: the unwavering commitment to a circle of competence. This is the profound and, in today's world, deeply countercultural idea that the key to success is not knowing everything, but rather knowing precisely what you don't know. It is the discipline of saying no to 99% of opportunities, not because they are bad opportunities, but because they fall outside the narrow, well-defined boundaries of your own expertise. It is the ultimate expression of intellectual humility, and it is the single greatest defense against the kind of catastrophic error that can wipe out a lifetime of hard work in a single bad decision. In a world that rewards the appearance of universal knowledge, Buffett has built an empire on the simple admission, "I don't know." The foundational anecdote that cemented the circle of competence into the legend of Warren Buffett was not an investment he made, but a massive, world-changing bubble he famously refused to participate in, the dot-com boom of the late 1990s. The context of the time is critical to understand the immense pressure he was under. From 1995 to early 2000, the world seemed to be reinvented daily. Companies with names like Pets.com, Webvan, and TheGlobe.com were appearing out of nowhere and achieving billion-dollar valuations without ever having turned a single dollar of profit. The narrative was intoxicating. This time, it's different. Old metrics like earnings and book value were declared obsolete, relics of a bygone industrial age. The new metric was eyeballs, or user growth. Financial television was a non-stop parade of 20-something tech founders who were billionaires on paper. And in the middle of this euphoric madness, there was Warren Buffett, the Oracle of Omaha, looking old, out of touch, and utterly clueless. His company, Berkshire Hathaway, which owned boring businesses like insurance, furniture, and candy, was dramatically underperforming the red-hot NASDAQ index. Barron's, the influential financial weekly, ran a cover story in 1999 titled, "Warren, What's Wrong?" The article questioned if the world's greatest investor had lost his Midas touch, suggesting he was a fossil, unable to grasp the new technological paradigm. The pressure was immense, not just from the media, but from his own shareholders, who watched their friends get rich on stocks like Qualcomm and Cisco, while Berkshire plodded along. Buffett's response to this public ridicule was a masterclass in disciplined inaction. He was invited to speak at Sun Valley, an exclusive conference for tech and media moguls. Everyone expected him to either defend his old-world philosophy or perhaps finally capitulate and announce a new tech investment. Instead, he gave a speech that was a quiet, methodical defense of his core principles. He didn't criticize the technology. He admired it. But he admitted, with complete candor, that he had no idea how to value these companies. He couldn't look out 10 or 20 years and have any reasonable degree of certainty about which of the hundreds of new internet companies would be the long-term winners. He explained that a business like Coca-Cola or Gillette had a durable competitive advantage he could understand. He could predict with high certainty that people would still be drinking Coke and shaving in 20 years. But he could not say the same for a search engine like Excite or a web portal like Lycos. He famously said, The most important thing to do if you find yourself in a hole is to stop digging. He was in a hole of underperformance, and the easiest thing in the world would have been to start digging, to buy a basket of tech stocks, just to quiet the critics and participate in the mania. But he refused. His inaction was total. He simply said, "This is outside my circle of competence." He was willing to look foolish, to underperform, to be called a has-been, rather than violate this core principle. Then, in March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a catastrophic collapse, eventually losing nearly 80% of its value. Those high-flying dot-com darlings went bankrupt in droves, fortunes were wiped out overnight. And Berkshire Hathaway, with its portfolio of boring, profitable businesses, sailed through the storm almost untouched. Its stocks soared as investors fled the tech wreckage and sought refuge in real value. Buffett wasn't a genius for predicting the crash. He never claimed to. He was a genius because he had the discipline to admit what he didn't know and the fortitude to do nothing about it. That single period of inaction saved his investors tens, if not hundreds of billions of dollars. It was the ultimate validation of the circle of competence. The underlying psychological principle at work here is a powerful defense against one of the most dangerous cognitive traps, the Dunning-Kruger effect, coupled with overconfidence bias. The Dunning-Kruger effect, identified by psychologists David Dunning and Justin Kruger, is a phenomenon where people with low ability at a task tend to dramatically overestimate their own competence. In essence, they are too incompetent to recognize their own incompetence. You see this everywhere. The amateur investor who, after a few lucky trades in a bull market, believes they are the next George Soros. The successful surgeon who assumes their intelligence in the operating room translates directly to genius in stock picking. The brilliant software engineer who decides to invest their life savings in a complex biotech venture based on a superficial understanding of the science. This is the path to ruin. Buffett's concept of the circle of competence is the ultimate antidote to Dunning-Kruger. It forces an individual to perform an honest and brutal self-assessment of their own knowledge. It's not about what you've heard of or what's popular. It's about what you understand at a granular level, as well as a world-class expert would. This is tied directly to overconfidence bias, the tendency for people to be more certain about their judgments than is objectively warranted. The more successful people become in one domain, the more likely they are to believe that success will translate to other domains. A successful real estate developer might think they can easily beat the stock market. A star marketing executive might believe they can pick winning technology startups. Buffett's discipline is a constant check on this bias. He is arguably the most successful capital allocator in history, yet he readily admits his ignorance about vast swaths of the economy. He doesn't understand semiconductor manufacturing, so he doesn't invest in it. He doesn't have a deep understanding of pharmaceutical development, so he avoids it. His inaction is a reflection of his profound intellectual humility. He understands that the line between competence and incompetence is a razor's edge, and the penalty for stepping over that line can be financial annihilation. By forcing himself to stay within his circle, he is not limiting his opportunities. He is drastically limiting his chances of making a catastrophic, unrecoverable error. The human brain is wired to want to feel smart and capable in all areas. The circle of competence is a mental model that acknowledges this dangerous wiring and builds a firewall against it, protecting your capital from your own ego. To make this concept a practical tool, you must undertake a deliberate process to define and then operate within your own circle of competence. This is an active, not a passive, mental model. The first step is an honest knowledge audit. Take a piece of paper and divide it into 3 columns. In the first column, labeled Expert, list the topics, industries, or skills where you have deep, professional-level knowledge. This is not what you have a casual interest in. This is knowledge you could be paid for. Maybe it's the industry you've worked in for 20 years. Maybe it's a skill you've dedicated 10,000 hours to mastering. Be brutally honest. For most people, this list will be very, very short. That's the point. In the second column, familiar, List topics you know something about but are not an expert in. Maybe you're a tech enthusiast who reads a lot about AI, but you don't actually know how to code a neural network. Maybe you enjoy reading about history, but you're not a professional historian. This column represents the danger zone, the area where the Dunning-Kruger effect is most potent. In the third column, clueless, list everything else. For Buffett, biotechnology and advanced software would go here. Be proud of how long this list is. It is a monument to your intellectual honesty. The second step is to draw the circle. Your circle of competence contains only the items from the expert column. Everything in the familiar and clueless columns is outside the circle. Your rule, your unbreakable vow, is that you will not make any active investment decisions, whether of capital or significant time, on anything outside that circle. No exceptions. This doesn't mean you can't learn and expand your circle over time, but the process of expansion must be deliberate and rigorous. To move a topic from familiar to expert requires years of dedicated study and experience, not just reading a few articles online. Step 3 is to create a too-hard pile. This is Buffett's famous mental filing cabinet. When an opportunity arises that is outside your circle, you don't waste a moment of mental energy on it. You don't try to get up to speed on it quickly. You don't ask for a hot tip. You smile, say this is outside my circle, and mentally place it in your too-hard pile. Then you move on. This simple act is a powerful way to conserve your decision-making energy for the opportunities that fall squarely within your small area of true expertise. This blueprint transforms a vague concept into a concrete operational system for any decision-maker. From an individual investor managing their personal finance to a CEO contemplating a major acquisition, it provides the clarity and discipline needed to avoid the biggest mistakes. The antithesis of this disciplined approach is a character we all know, perhaps a character we have all been at some point, the intellectual dabbler, the jack-of-all-trades investor. This person is intelligent, curious, and often successful in their primary career. But this very intelligence becomes their downfall in the world of investing and business strategy. They read the Wall Street Journal, they listen to podcasts, they feel they have a good general sense of how the world works. Their portfolio is a chaotic reflection of the last 6 months of financial headlines. When oil prices are high, they buy an oil company. When a tech company announces a new metaverse strategy, they buy a few shares of that. When a friend who works in healthcare mentions a promising new drug, they make a speculative bet on a small biotech firm. They have mistaken familiarity for competence. They know just enough about each of these areas to be dangerous, to feel confident in their decision, but not enough to understand the deep risks, the competitive landscape, the regulatory hurdles, or the true drivers of long-term value. Their decision-making process is a mile wide and an inch deep. This path almost always leads to disaster. The dabbler might get lucky once or twice, reinforcing their Dunning-Kruger-fueled overconfidence. But inevitably they will stray into a field they fundamentally misunderstand and suffer a catastrophic loss. The doctor who invests in a mining company without understanding commodity cycles. The lawyer who buys a trendy software stock at 100 times sales without understanding customer acquisition cost. These are classic examples. They are playing a game where other players have a massive informational and analytical advantage. They are the tourist at the poker table with the seasoned professionals. They are destined to lose. In the world of entrepreneurship, this is the founder who tries to be everything to everyone, expanding into new markets and product lines they don't understand, driven by ego and a lack of focus. They dilute their brand, they exhaust their resources, and they fail to dominate their core niche. The path of the 99% is littered with the brilliant failures of those who did not have the humility to admit what they didn't know. They did not respect the boundaries of their own competence, and they paid the ultimate financial price for their intellectual arrogance. The direct financial connection of the circle of competence is, at its core, about risk management and the preservation of capital. The single most important rule in investing, according to Buffett, is rule number 1: never lose money. Rule number 2, never forget rule number 1. Losing money is not just a financial setback. It's a mathematical catastrophe. If you have $100,000 and you lose 50%, you have $50,000. To get back to your starting point, you don't need a 50% gain, you need a 100% gain. The climb back is twice as steep as the fall. The primary function of the circle of competence is to prevent you from suffering these devastating, portfolio-crippling losses. By only investing in businesses you understand inside and out, you dramatically reduce the probability of being blindsided by a risk you didn't even know existed. You understand the levers of the business, the threats on the horizon, and what a reasonable range of outcomes looks like. This translates directly to a lower permanent loss of capital. A study of professional fund managers shows that the biggest predictor of long-term underperformance is not a lack of big winners, but the presence of a few catastrophic losers. A single investment that goes to zero can wipe out the gains from 5 or 6 successful investments. The circle of competence is a systematic way to avoid the zeros. Think of your capital as your army. Sending it to fight on a battlefield you don't understand, the territory of biotechnology or complex derivatives, for example, is a surefire way to get your army wiped out. By keeping your army on the terrain you know intimately, you maximize its chances of victory and, more importantly, survival. This preservation of capital is the foundation upon which the magic of compounding is built. You cannot compound money that you have lost. Staying within your circle ensures that your financial base remains intact, ready to be deployed with massive force when a truly great opportunity, one that you fully understand, presents itself. The financial advantage isn't just about picking more winners, it's about rigorously avoiding the losers, and that makes all the difference. So we have established the need for extreme selectivity with the punch card and the intellectual humility of the circle of competence. But even with these 2 pillars in place, a crucial element is missing. You may have a punch ready, and you may have identified a wonderful business that you understand completely, but the price might be wrong. The third fundamental pillar of selective inaction is the discipline of waiting for the fat pitch. This is an analogy Buffett borrows from the baseball legend Ted Williams, who in his book The Science of Hitting, explained that the key to his success was not swinging at every pitch. He mentally divided the strike zone into 77 baseballs, and he knew from experience he could only hit the balls in his sweet spot with a high average. He would wait patiently for the pitch to come right into that sweet spot. He was willing to take a strike on a borderline pitch, even if the crowd booed, because he knew his odds of success were much higher if he waited for the perfect opportunity. For Buffett, this translates to waiting for a wonderful business to be offered at a ridiculously attractive price, a price far below its underlying intrinsic value. This requires a level of patience that few possess, the ability to watch a great company's stock price go up and up, refusing to chase it, and waiting, sometimes for years, for a moment of market panic or temporary trouble to create the perfect buying opportunity. The foundational anecdote that perfectly captures this principle is Buffett's landmark investment in the Washington Post Company in 1973. This story is a masterclass in patient, value-driven decision-making. At the time, Buffett was an avid reader and a deep admirer of the newspaper business, especially high-quality, dominant papers like the Post. He understood its business model completely. It was squarely within his circle of competence. He recognized that its dominant position in a major city gave it a powerful economic moat, a durable competitive advantage that was very difficult for a competitor to assail. He had watched the company for years. Then, in 1_9_73 in 1974, the stock market entered a brutal bear market. The entire market was gripped by fear and pessimism, fueled by an oil crisis and economic recession. On top of this general market malaise, the Washington Post itself was facing some specific headwinds, including the threat of a strike. The company's stock, which had been trading at over $30 a share, began to plummet. Wall Street, with its typical short-term focus, saw only problems and uncertainty. Analysts downgraded the stock, and investors fled in droves. The stock price fell below $20, then to $15, and kept going down. Buffett, however, saw not risk, but opportunity. He wasn't focused on the next quarter's earnings or the threat of a strike. He was focused on the intrinsic value of the business. He performed a simple but profound calculation. He looked at the entire company's market capitalization, the total value of all its shares. At the depressed price, the entire Washington Post company, which included the newspaper, Newsweek magazine, and several profitable television stations, was being valued by the stock market at around $80 million. Buffett then did his own private appraisal. He knew from his knowledge of the media industry that the television stations alone were worth more than $80 million. In fact, a single one of its TV stations was probably worth that much. This meant that if he bought the whole company at the current market price, he would be getting one of the world's most prestigious newspapers, Newsweek magazine, and several other assets for free. The market was offering him a dollar bill for 40 cents. This was the fat pitch Ted Williams dreamed of. It was a no-brainer. But even then, he didn't rush. He patiently accumulated shares throughout 1973 as the price continued to fall, buying more and more as the market became more and more pessimistic. He invested nearly $11 million, a significant portion of Berkshire's capital at the time. He didn't care that the stock price continued to drift downward after he bought it. He knew what the business was worth. The market's opinion was irrelevant. His patience was rewarded beyond his wildest dreams. That $11 million investment would, over the next few decades, grow to be worth over $1 billion, a return of more than 100 to 1. It became one of the cornerstone investments of Berkshire Hathaway. This monumental success was not the result of a brilliant prediction or complex financial engineering. It was the simple, disciplined act of calculating a business's true worth and then waiting, with absolute patience, for a fearful market to offer it to him at a price that was almost laughably cheap. The psychological principle that Buffett masterfully overcomes with this fat-pitch discipline is one of the most powerful and destructive biases in all of human cognition: loss aversion. Pioneered by psychologists Daniel Kahneman and Amos Tversky, loss aversion describes the empirical finding that for human beings, the psychological pain of losing is about twice as powerful as the pleasure of gaining. A $1,000 loss feels as bad as a $2,000 gain feels good. This asymmetry has profound implications for investor behavior. When the market is crashing, as it was in 1973, the pain of seeing your portfolio value drop is intense. The overwhelming instinct driven by loss aversion is to sell, to make the pain stop, to get to safety. This is precisely why most people sell at the bottom, locking in their losses. Conversely, when the market is soaring in a bubble, the primary emotion is not greed, but the fear of missing out, or FOMO, which is itself a form of loss aversion, the fear of losing potential gains that your friends and neighbors are all enjoying. This fear compels people to buy at the top, just as the bubble is about to burst. Buffett's entire approach is a calculated rebellion against this destructive instinct. His famous advice to be fearful when others are greedy, and greedy only when others are fearful, is a direct prescription to counteract loss aversion. When the market is panicking and everyone is selling, as with the Washington Post, he knows that this is the moment when loss aversion is at its peak. This emotional selling creates the very opportunities he seeks, wonderful businesses being sold at bargain prices. His rational calculation of intrinsic value acts as an anchor, a solid rock in a sea of emotional turmoil. It allows him to lean against the wind, to buy when every fiber of the collective human psyche is screaming, "Sell!" Similarly, when the market is euphoric and everyone is greedy, he sits patiently in cash. He feels no FOMO. He simply observes that prices are far above intrinsic value. The pleasure of participating in the mania is not worth the catastrophic risk of buying at the peak. This discipline is not easy. It requires a level of emotional detachment that is almost inhuman. It means being willing to look wrong in the short term, to feel the social pressure of non-participation. But it is this mastery over the deep-seated, primitive fear of loss that separates the truly great investor from the masses. He has rewired his brain to see a crashing market not as a source of pain but as a source of opportunity. To apply this mental model of waiting for the fat pitch, you need a systematic process. This is the blueprint for transforming yourself from a price taker into a value-driven opportunist. The first step is to create a curated watch list. This is not a list of hot stocks. It is a small, manageable list of wonderful businesses within your circle of competence that you would love to own one day. These are companies you have already researched, whose business models you understand, and whose long-term prospects you admire. For each company on your watch list, the second step is to do the work of calculating a conservative estimate of its intrinsic value. There are complex ways to do this, like discounted cash flow analysis, but a simpler method is to look at its historical earnings power and assign a reasonable multiple, or to appraise the value of its assets as Buffett did with the Post's TV stations. The goal is not to find a precise number, but a conservative range of what the entire business would be worth to a private buyer. Step 3 is the most crucial and the most difficult: setting your price and being patient. For each company on your list, you determine the price at which you would be willing to buy, your fat pitch price. This is not the current price. It should be a significant discount to your calculated intrinsic value. This discount is what Benjamin Graham called the margin of safety. It could be 30%, 40%, or even 50% below your estimate. This margin of safety is what protects you from errors in your own judgment and from unforeseen negative events. Once you have set your price, you do nothing. You set price alerts, and you wait. You might wait for months. You might wait for years. The company's stock might go up 50% from its current price. You do not chase it. You stick to your number. Your work is already done. Step 4 is acting decisively when the pitch arrives. A market crash, an industry-wide panic, or a company-specific problem might suddenly bring the stock price down to your predetermined buy zone. Because you have done the work in a calm, rational state of mind, you can now act with speed and conviction while everyone else is panicking. You are not making a rushed, emotional decision. You are executing a plan you laid out long ago. This systematic approach removes emotion from the buying process and turns you into a patient predator, waiting calmly for the market to serve up the opportunity you desire on your own terms. The antithesis to this patient, value-driven approach is the momentum chaser, the FOMO investor. This individual's investment philosophy can be summed up in one sentence: it's going up, so I should buy it. They have no concept of intrinsic value. For them, the price of an asset is simply a reflection of its popularity. They see a stock like Tesla or a cryptocurrency like Bitcoin soaring, and they are consumed by the fear of being left behind. They see stories of overnight millionaires and think, that could be me. They don't study the balance sheet, they don't analyze the competitive landscape, they don't calculate a margin of safety. They just buy, often at the very peak of the mania, because the social proof is overwhelming and the desire to participate is unbearable. They are the person who bought .com stocks in late 1999, housing in 2006, or speculative digital assets in 2021. Their portfolio is a museum of past bubbles. The inevitable outcome for the momentum chaser is brutal. When the narrative changes and the bubble bursts, they are left holding the bag. Having bought with no understanding of the asset's underlying worth, they have no anchor to hold on to as the price plummets. Their only data point, the upward momentum, has vanished. Panic sets in, and they typically sell near the bottom, crystallizing a devastating loss. They have perfectly executed the investor's mantra of buy high, sell low. In the world of corporate strategy, this is the CEO who chases fads. When big data is the buzzword, they spend millions on a big data initiative without a clear strategy. When AI is the hot new thing, they announce a major AI push to appease shareholders, again without a deep understanding of how it will create value. They are always reacting, always chasing, never acting from a position of deep intrinsic value-based strategy. The path of the 99% is a frantic, exhilarating, and ultimately destructive chase after rising prices and popular narratives. It's a game that is thrilling to play on the way up and financially fatal on the way down. The direct financial connection between waiting for the fat pitch and superior returns is the concept of the margin of safety. This is perhaps the most important financial concept in all of value investing. When you buy a stock for a price significantly below your calculation of its intrinsic value, you are creating a buffer that provides twofold protection and a massive upside. Firstly, it protects your downside. If you were wrong in your analysis, if the company's future earnings aren't as good as you predicted, or if an unexpected event occurs, the discount at which you purchase the asset gives you a cushion. If you value a company at $100 per share and buy it for $50, the business can underperform your expectations by a huge amount, and you can still avoid a loss. It is the financial equivalent of building a bridge that can hold a 30-ton truck when you only ever expect to drive a 10-ton truck across it. This dramatically reduces the probability of suffering a permanent loss of capital, fulfilling Buffett's #1 rule. Secondly, and just as importantly, the margin of safety is the engine of outsized returns. When the temporary problem that caused the stock to be mispriced is resolved, or when the market panic subsides, the stock price doesn't just recover to its intrinsic value, it often overshoots it. By buying at $50 a share a business that is worth $100, you are not aiming for a small gain. You have a built-in 100% return, just for the price to return to a fair valuation. This asymmetry, limited downside risk and massive upside potential, is the holy grail of investing. It is how fortunes are made. Let's quantify it. An investor who consistently buys assets at a 50% margin of safety and sees them return to fair value over a few years will generate annualized returns that are mathematically almost impossible for a momentum chaser or a market timer to replicate over the long term. It is a systematic way of tilting the odds dramatically in your favor. The patience to wait for that fat pitch is not a passive act of laziness. It is the active strategic positioning that creates the low-risk, high-return opportunities that are the sole domain of the world's most successful investors. We have now assembled a powerful trio of principles: the selectivity of the punch card, the humility of the circle of competence, and the patience to wait for the fat pitch. But there is a force so powerful it can shatter all of this discipline in an instant. It is the noise of the crowd, the relentless pressure of the outside world to conform, to act, to follow. To withstand this force requires the fourth fundamental pillar of selective inaction, the mastery of the inner scorecard. This is the idea that you must define your own metrics for success and live by them, regardless of what the rest of the world thinks. The world runs on an outer scorecard: your job title, the size of your house, the quarterly performance of your portfolio, the number of likes on your social media post. It is a constant, screaming judgment from the outside. The inner scorecard, by contrast, is your own judgment of your performance based on your own principles and long-term goals. To practice selective inaction, especially when it means looking foolish or falling behind in the short term, you must be constitutionally incapable of caring about the world's outer scorecard. Your validation must come from within. The foundational anecdote for this pillar is less about a single transaction and more about a sustained, career-long philosophy, but it is powerfully illustrated by Buffett's multi-decade investment in the Coca-Cola Company. Buffett made his major investment in Coke in 1988, after the market crash of 1987. He saw a phenomenal, globally dominant business selling at a reasonable price, a fat pitch within his circle of competence. He invested over $1 billion, making it one of Berkshire's largest holdings. What followed is the true test of the inner scorecard. Over the next 30-plus years, Buffett simply held the stock. He did almost nothing. But during that time, the world was anything but quiet. There were recessions, like in the early 1990s and 2001. There was the Asian financial crisis in 1997. There was the dot-com bust where Coke, an old economy stock, looked like a dinosaur. There was the 2008 global financial crisis, the greatest economic catastrophe since the Great Depression. There were periods when Coke's growth slowed, when new health trends questioned the future of sugary drinks, when new competitors emerged. At each of these moments, the outer scorecard was screaming, "Sell!" Pundits questioned if Coke's best days were behind it. Analysts issued downgrades. The stock price would fall 20%, 30%, even 40% during these periods of panic. The average investor, governed by the outer scorecard of their portfolio's daily value, would have been terrified. The pressure to do something, to sell and cut their losses, or to sell and move on to the next hot thing, would have been immense. Buffett did nothing. His inner scorecard was not based on the daily stock price. It was based on a simple set of questions. Is Coca-Cola still selling more cases of its product this year than last year? Is its global brand still one of the most powerful in the world? Is its long-term competitive position still intact? As long as the answers to those questions were yes, the short-term fluctuations of the stock price were, to him, meaningless noise. He was judging the performance of the business, not the mood of the market. He tells a story about his father, a stockbroker, and how his clients would be ecstatic if a stock they bought went up immediately and miserable if it went down, even though nothing about the underlying business had changed. Buffett learned early on that this was insanity. You should prefer the stock to go down after you buy it, so you can buy more at a cheaper price. This mindset is only possible if you have an unshakable inner scorecard. Because he held on, because he ignored decades of outside noise and focused only on his own internal metrics, that $1 billion investment in Coca-Cola has paid Berkshire tens of billions of dollars in dividends alone, and the stock position itself has grown to be worth over $25 billion. This colossal victory was achieved not through brilliant trading, but through the supreme psychological discipline of inaction, an inaction fueled by a complete and total disregard for the outer scorecard. The underlying psychological principles that the inner scorecard is designed to combat are arguably the most powerful forces in social psychology: social proof and herd behavior. Human beings are social animals. For hundreds of thousands of years, our survival depended on our ability to stick with the tribe. The individual who saw the rest of the tribe running and decided to stand still was likely to be eaten by a saber-toothed tiger. We are hardwired to believe that if everyone else is doing something, it must be the right thing to do. This is social proof. When we are uncertain, we look to others for cues on how to behave. In the financial markets, this ancient survival instinct is a catastrophic liability. When a stock is soaring, and everyone, your neighbor, your taxi driver, the experts on TV, is buying it, the social proof is overwhelming. The feeling is not just one of greed, but of a deep-seated fear of being left alone, of being the only one missing out. This is the engine of a bubble. Conversely, during a market crash, the social proof is just as powerful. Everyone is panicking, everyone is selling. The instinct to join the herd and run for safety is almost irresistible. The inner scorecard is a conscious, deliberate effort to sever this psychological tether to the herd. It is a declaration of intellectual independence. It is the recognition that the crowd, in financial markets, is almost always wrong at the most important turning points. The crowd is euphoric at the top and despondent at the bottom. By creating your own set of principles, your own definition of success, you are creating an alternative source of validation. You no longer need the approval or the agreement of the crowd to know you are making a good decision. Your validation comes from checking your decision against your own rational, pre-established principles. Are you acting within your circle of competence? Did you buy with a sufficient margin of safety? Is the long-term health of the business intact? These are the questions on the inner scorecard. They are logical and timeless. The questions on the outer scorecard. What is the stock price today? What is everyone else doing? Am I keeping up with the S&P 500 this quarter? Are emotional and fleeting. Mastering the inner scorecard is about reprogramming your brain to find safety and comfort in rational independence rather than in the warmth of the herd, a herd that is almost always stampeding toward a cliff. So how do you build and apply this mental model? How do you forge an inner scorecard strong enough to withstand the gale force winds of public opinion? Step 1. is to write down your personal investment philosophy. This is your constitution. It should be a 1 or 2-page document that clearly articulates your goals, your strategy, and your principles. What is your time horizon? It should be measured in decades. What is your definition of risk? It should be permanent loss of capital, not short-term volatility. What are the core tenets you will never violate? E.g., I will only buy businesses I understand. I will always demand a margin of safety. This document should be written during a time of calm and clarity, not in the middle of a market storm. It is the scripture you will turn to when you are feeling emotional and uncertain. Step 2 is to define your metrics for success, independent of the market. Instead of measuring your portfolio's value daily, commit to only checking it once a quarter or even once a year. Your primary metrics should be related to the performance of the businesses you own. If you own a piece of a company, get the quarterly and annual reports. Are its revenues growing? Are its profit margins stable or increasing? Is it gaining market share? You are a business owner, not a gambler renting a stock. Judge your success on the long-term progress of your businesses. Step 3 is to curate your information diet. The 24/7 financial news cycle is the primary delivery mechanism for the outer scorecard. It is designed to provoke an emotional response, fear or greed, to keep you watching. A crucial part of building an inner scorecard is to ruthlessly cut this out of your life. Stop watching financial news. Unfollow market gurus on social media. Your information should come from primary sources, company reports, industry journals, books, information that is deep and timeless, not shallow and urgent. Step 4 is to embrace being different. Understand that a strategy of selective inaction will, by definition, mean that you will look and feel out of sync with the rest of the world most of the time. There will be years when your patient approach underperforms. You must learn to be comfortable with this, to derive a quiet satisfaction from your discipline, knowing that you are playing a different, longer game. This blueprint is not easy, but it is the only way to build the psychological fortress necessary to execute a successful long-term investment strategy. The antithesis is the path of the 99%, embodied by the market-obsessed investor. This person's sense of well-being is directly tied to the daily fluctuations of the Dow Jones Industrial Average. They wake up and the first thing they do, before even getting out of bed, is check their brokerage account on their phone. If the market is up, they feel happy, smart, a financial genius. If the market is down, a cloud of anxiety and self-doubt descends upon them for the rest of the day. Their mood, their confidence, their very sense of self-worth is dictated by the green and red arrows on a screen. They are completely enslaved by the outer scorecard. Because their emotional state is so volatile, their decision-making is abysmal. They are constantly reacting to noise. A scary headline about a trade war sends them into a panic, selling their best companies. A rumor about a new product from a hot tech company causes them to pile in, buying at an absurd valuation. They are a puppet, and the market is the puppet master, pulling their emotional strings. This behavior leads to a predictable and disastrous financial outcome. Studies, such as the Dalbar quantitative analysis of investor behavior, have consistently shown for decades that the average investor's returns are significantly lower than the returns of the very mutual funds or indexes they are invested in. How is this possible? The gap is explained almost entirely by bad timing. The average investor, driven by the herd behavior that the outer scorecard encourages, consistently buys after prices have already gone up and sells after prices have already gone down. They chase performance and flee from volatility. They are their own worst enemy. The market-obsessed investor confuses the stock market, which is a short-term voting machine, with the underlying businesses, which are long-term weighing machines. They spend all their time watching the votes, which are fickle and emotional, and no time understanding the weight, which is the only thing that matters in the long run. The path of the 99% is one of emotional servitude to the market's daily whims, a path that guarantees a transfer of wealth from the impatient to the patient. from those with an outer scorecard to those with an inner scorecard. The direct financial connection is quantifiable and profound. The term for the performance gap created by emotional, outer scorecard-driven decisions is the behavior gap. This gap represents the difference between the return of an investment and the return of the average investor in that same investment. For example, over a 20-year period, the S&P 500 might generate an average annual return of, say, 10%. The average equity investor over that same period, however, might only earn 6% or 7%. That 3 to 4% annual difference is the behavior gap. It is the financial cost of listening to the outer scorecard. A 3% difference in annual returns might not sound like much, but over a lifetime of investing, the impact of compounding makes it a chasm. A $100,000 investment earning 10% a year for 30 years grows to over $1.7 million. That same investment earning 7% a year grows to just over $760,000. The behavior gap, the cost of frantic, emotional decision-making, has cost this investor nearly $1 million. It is a massive, self-inflicted financial wound. The inner scorecard closes this gap by forcing you to ignore the market's short-term mood swings and focus on the long-term fundamentals of the businesses you own. It prevents you from making those catastrophic timing mistakes. It allows you to capture the full return that your investments generate. The financial benefit is not theoretical. It is a direct, massive, and quantifiable increase in your ultimate wealth, achieved simply by substituting your own judgment for the madness of the crowd. We have now reached the apex of our deconstruction. We've explored the necessity of a punch card for selectivity, a circle of competence for focus, a fat pitch mentality for patience, and an inner scorecard for psychological fortitude. The fifth and final pillar is where all these principles converge and are institutionalized at a colossal scale. This is capital allocation as patient predation, as perfectly embodied by the structure and operation of Berkshire Hathaway itself. Berkshire is not just a company that Warren Buffett runs, it is the physical manifestation of his entire philosophy of selective inaction. It is a machine designed to do one thing: patiently collect vast sums of capital from its operating businesses, and then wait, sometimes for years, for the perfect, unmissable opportunity to deploy that capital with overwhelming force. This is the ultimate synthesis of the art of sitting still and the decisiveness of a lethal strike. It transforms capital allocation from a series of mundane budget decisions into a high-stakes, strategic hunt. The most powerful foundational anecdote illustrating this principle is Berkshire Hathaway's actions during the absolute darkest days of the 2008 global financial crisis. To understand the story, you must first understand the years leading up to it. From roughly 2003 to 2007, the global economy was booming. The stock market was reaching new highs, and a frenzy of corporate deal-making was in full swing, fueled by cheap debt. Private equity firms were buying companies at ever higher valuations. CEOs were making acquisitions left and right. The pressure for Buffett and Berkshire to do something with their rapidly growing pile of cash was enormous. Wall Street analysts and the financial press were once again questioning him. Why was he sitting on tens of billions of dollars in cash, earning a pitiful return, when the market was on fire? It looked like another case of the old man missing the party. But Buffett, operating with his punch card, his circle of competence, and his inner scorecard, saw no fat pitches. He saw rampant speculation, dangerous levels of leverage, and prices that were completely disconnected from intrinsic value. So he did nothing. He patiently allowed Berkshire's cash hoard to grow, from $20 billion to $30, then to over $40 billion. He was building his war chest, conserving his ammunition while everyone else was firing wildly. His inaction was a deliberate, strategic choice. Then, in September of 2008, the world fell apart. Lehman Brothers collapsed. The global credit markets froze solid. Panic swept through the financial system on a scale not seen since 1929. The very foundations of global capitalism seemed to be cracking. In this moment of absolute terror, when capital was the scarcest and most valuable commodity on the planet, Warren Buffett's phone started ringing. He was no longer the old man who had lost his touch. He was the only person with both the capital and the courage to act. In the span of just a few weeks, he became the lender and investor of last resort to corporate America. First, he invested $5 billion in Goldman Sachs, the premier investment bank, in the form of preferred stock yielding a remarkable 10% dividend, and he received warrants to buy more stock at a fixed low price. Days later, he invested $3 billion in General Electric, another pillar of the American economy, on similarly favorable terms. The next year, he would provide financing to Mars to acquire Wrigley, and later make a massive investment in Bank of America. These were not small tentative moves. These were decisive multi-billion-dollar strikes at the very heart of the crisis. He was not trying to catch a falling knife. He was providing life-saving capital to fundamentally sound institutions that he knew the U.S. government would not allow to fail. He was leveraging years of patient inaction into a handful of deals that would generate tens of billions of dollars in profits for Berkshire Hathaway. He was the predator who had waded through years of drought and, when the weakened prey came to the waterhole, he struck with breathtaking speed and force. This was the ultimate culmination of his entire philosophy. Years of doing nothing, followed by a few weeks of intense, world-altering action. The psychological principle at the heart of this patient predation is the direct counter-narrative to the action bias. As we discussed at the beginning, the action bias is the deep-seated human compulsion to act, even when inaction is the more rational course. In the corporate world, this bias is rampant. CEOs and executives are paid to make things happen. Their boards, their shareholders, and their own egos demand activity. A CEO who simply sits on a pile of cash for 3 years, waiting for a crisis, would likely be fired for being passive or lacking vision. The prevailing mindset is that a good leader is always in motion, always making deals, always launching initiatives. This creates a culture of doing something for the sake of being seen as doing something. This leads to value-destroying acquisitions made at the top of the market, ill-conceived product launches, and a general state of what one might call strategic churn. Buffett's approach recognizes that in the world of capital allocation, action is the enemy of high returns. Great opportunities are, by their very nature, rare. They do not appear on a quarterly schedule, therefore, the default setting for a master capital allocator must be no. The default must be inaction. This reframes patience not as passivity, but as a strategic weapon. The cash that Berkshire holds is not a sign of a lack of ideas. It is dry powder. It is option value. It gives Berkshire the ability to act with stunning speed and on a massive scale when others are forced to retreat. While other companies were over-leveraged and fighting for survival in 2008, Berkshire was playing offense. This requires a profound shift in the CEO mindset. It requires measuring a leader not by the volume of their decisions, but by the quality and timing of a very small number of critical decisions. It is a philosophy that values the discipline of the sentry, who watches and waits for years without incident, over the frantic energy of the soldier who is always charging into battle. It is the understanding that in the game of long-term wealth creation you are paid not for effort, but for judgment, and supreme judgment often dictates doing nothing at all. This blueprint for capital allocation as patient predation can be applied by any entrepreneur, executive, or even an individual investor. Step 1 is to prioritize the building of a war chest. This means making a conscious, strategic decision to value liquidity and a strong balance sheet over short-term growth or immediate action. For a business, it means resisting the temptation to immediately reinvest every dollar of profit back into the business or distribute it to shareholders. It means deliberately building up a cash reserve that is earmarked for strategic opportunities. For an individual, it means building an emergency fund that goes far beyond the standard 3 to 6 months of expenses. It means having a significant opportunity fund in cash or cash equivalents ready to be deployed. Step 2 is to define the gating criteria for deploying that war chest. What does an opportunity have to look like for you to open the gates and deploy your capital? These criteria must be incredibly stringent. For Buffett, it's a crisis-level event that allows him to buy great businesses at bargain prices or to become a preferred lender to a desperate but solid institution. For your business, it might be the chance to buy your #1 competitor if they face financial distress, or the opportunity to acquire a key piece of technology at a fire sale price. For an individual, it's a stock market crash of 30% or more, creating a generational buying opportunity. These criteria must be written down in advance during a time of calm. Step 3 is the discipline of the wait. This is the hardest part. It means being willing to underperform or feel unproductive for long stretches of time while your cash earns very little. It requires having an inner scorecard that values preparedness over activity. You must constantly remind yourself that the purpose of the cash is not to generate a return today, but to enable you to generate a spectacular return tomorrow. Step 4 is the decisive strike. When an event occurs that meets your predefined, stringent criteria, you must act with speed, courage, and conviction. You deploy a significant portion of your war chest, as Buffett did in 2008. Because you have a plan, you are operating from a position of strength and logic while the rest of the world is paralyzed by fear and uncertainty. This transforms capital allocation from a reactive budgeting exercise into a proactive, strategic hunt for extraordinary, game-changing opportunities. The antithesis of this model is the deal-a-month CEO, or the hyperactive entrepreneur. This leader is addicted to the thrill of the deal. They believe that constant acquisition and expansion is the only path to growth. They have a massive team, dedicated to corporate development, and their primary metric of success is deal flow. They are always buying something, merging with someone, or launching a new strategic alliance. The problem is that most of these deals are mediocre. They are made at fair or even inflated prices, and the much-touted synergies rarely materialize. The company becomes a complex, unwieldy mess of poorly integrated businesses, and the management team is so busy with the next deal that they fail to properly run the assets they already own. This constant activity creates the illusion of progress, but a close look at the company's return on invested capital tells a different story. It is often stagnant or declining. The company is getting bigger, but not better. It is a diversification strategy, as the legendary investor Peter Lynch would call it. The deal-a-month CEO is a value destroyer, churning capital for the benefit of investment bankers and their own ego, not for the long-term benefit of the shareholders. They are a perfect example of the action bias run amok in the executive suite, a strategic path that guarantees mediocrity and often eventual failure. The direct financial connection of this patient predation model is best measured by long-term return on invested capital, or ROIC. ROIC is a financial metric that shows how efficiently a company is using its capital to generate profits. A company that constantly makes mediocre acquisitions at high prices will see its ROIC trend downwards. A company that is a patient predator, like Berkshire Hathaway, will exhibit a different pattern. Its ROIC might be lower during the long periods of waiting when it holds a lot of cash. But this is followed by dramatic upward spikes when that cash is deployed into incredibly high return opportunities. Over a full market cycle, the average ROIC of the patient allocator will be vastly superior to that of the hyperactive acquirer. For an individual investor, the same principle applies. Holding cash reduces your short-term portfolio returns, but deploying that cash during a market crash allows you to buy assets at such low prices that your long-term annualized return, your personal ROIC, will be dramatically enhanced. Quantitatively, the deals Buffett did in 2008 and 2009 generated safe, bond-like returns of 10% plus massive equity upside through warrants. These were double-digit returns locked in at a time when the rest of the world was facing near certain losses. This is the ultimate financial advantage of selective inaction. It allows you to transform periods of maximum market risk into moments of minimum personal risk and maximum return. It is the final powerful synthesis of the entire Buffett system. Wait, 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 and then strike. not with a scalpel but with a sledgehammer. You have just been given a powerful and dangerous tool. You have absorbed the operating system of one of the world's most successful minds. The principle of selective inaction, the deliberate strategic decision to do nothing, is a profound competitive advantage in a world that is addicted to doing everything. You now understand how the extreme selectivity of the punch card forces quality over quantity. You see how the intellectual humility of the circle of competence protects you from catastrophic error. You grasp how the patience to wait for the fat pitch transforms you from a price taker to an opportunist. You have the blueprint for forging an inner scorecard to grant you immunity from the madness of the crowd. And you have seen how all of this culminates in a strategy of patient predation, conserving capital for those rare moments of generational opportunity. This is more than just a theory. It is a mental arsenal that can shield you from the biases and impulses that sabotage the financial lives of the 99%. But mastering this tool, this principle of when to act, is only one half of the equation. A predator that has perfected the art of waiting is still useless if it doesn't know what prey to hunt for. The system of selective inaction is just one crucial node in a much larger network of interconnected mental models that Buffett uses to navigate the world. Knowing when to swing is powerful, but it's nothing without the deep knowledge of what to swing at. How do you identify a business with a durable competitive moat? How do you analyze management's trustworthiness and skill? How do you think about valuation beyond simple metrics? These are not separate ideas. They are interlocking gears in a single powerful machine for thinking. You have just mastered one of the most important gears, but the machine is not yet complete. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical step in your journey. Think of what you've just learned as one piece of a map. The video on the screen is the next piece. It is the link that connects the when of inaction to the what of a truly great opportunity. It is the bridge between the discipline you've just acquired and the knowledge required to apply it with devastating effectiveness. The choice you face right now is not about what to watch next. It is a choice about who you want to become. Are you a tourist, collecting interesting ideas? Or are you an architect, committed to building the complete mental framework required for high performance and true financial freedom? The journey to mastery is a series of deliberate steps. This is the next step. Continue your ascent. Complete the arsenal. Click the video.